At the end of the 1990s, the internet wasn't just a new technology, it was the future. A revolution, a force people believed would reshape every industry on Earth. And for a brief moment, it looked unstoppable. Tens of billions of dollars were pouring into young startups that promised to change the world, even if some of them barely had a functioning website. Investors, venture capitalists, and everyday people rushed in, convinced that the web was a goldmine that could make anybody rich. But by the early 2000s, that same unstoppable boom collapsed into one of the biggest market crashes in history. The story starts in the early 1990s, when the internet moved out of the universities and into everyday life. Email became mainstream, websites started popping up everywhere, and for the first time, regular people could browse the web from home. Slowly, and with loud dial-up sounds, but it worked. Those early years created a wave of optimism. The internet felt like magic. And if you were building anything online, Wall Street saw you as the future. In 1994, Netscape, the browser that helped people explore the web, was founded. Just a year later, it went public, and its stock price exploded on day one. This moment signaled something bigger. Tech wasn't just growing, it was taking over. From there, money flooded into Silicon Valley, faster than companies could handle it. By the mid to late 90s, the economy was buzzing. The Federal Reserve kept interest rates low. Venture capitalists were aggressively funding internet startups. And the Nasdaq, the tech-heavy stock index, seemed to do only one thing: rise. New companies appeared weekly, each with bold visions and futuristic promises. Many of them were barely more than ideas, but that didn't matter. During this period, startups with zero profit were valued in the hundreds of millions. Companies like Pet.com, Webvan, eToys, and hundreds more sprinted into the public markets, spending money faster than they could earn it. All they needed was a pitch, and hype did the rest. Meanwhile, the Nasdaq soared nearly 400% between 1995 and 2000. But behind that excitement, the foundation was cracking. The internet was real, but the business models weren't. Many dot-com startups had the same problem. They weren't making any money, at all. Yet, Wall Street kept pushing them higher because they believed something dangerous. Profits don't matter, growth is everything. Pets.com became the iconic example. A company that went national before it even had a sustainable plan. It spent more on advertising than it earned in sales. But the illusion wouldn't last. March 2000 was the turning point. The Federal Reserve raised interest rates several times, making money more expensive to borrow. Suddenly, investors became cautious. Then, one by one, tech companies began missing earnings expectations. Confidence snapped, and the selling began. The Nasdaq started to fall, slowly at first, then violently. Between March 2000 and late 2002, the Nasdaq plunged 78%. Trillions of dollars vanished. Across Silicon Valley, the bubble popped. Pets.com shut down, Webvan filed for bankruptcy, eToys collapsed, and nearly half of all internet startups disappeared completely. The crash reshaped the tech world. It cleared out the companies built on hype, but it also left behind a set of survivors. The ones with real products, real vision, and real long-term value. Amazon rebuilt itself and grew into a global powerhouse. eBay thrived. Google, founded in 1998, emerged stronger than ever. The dot-com bubble wasn't just a financial crisis. It was a lesson about human behavior. It revealed the danger of valuing growth over substance. But perhaps the biggest takeaway is this. The future can be real, but that doesn't mean every company claiming it we'll get there. Be sure to hit that like button, subscribe to the channel, and turn on notifications. We post weekly reels and new videos on Fridays. Thank you all for watching, and as always, remember to always save smart and invest smarter.